wanted to bring some heavy hitters to have this conversation with you guys today. So I will let Adrienne and Alan introduce themselves.
Awesome. Hey, everyone. My name is Adrienne Davis. I am a financial planner here at Zenith. I am based out of the Maryland area. I am a certified public accountant as well as certified financial planner, and I joined Zenith 2 years ago, almost in November. Any other things I should say? No? Okay.
All right. Good evening, everyone. My name is Alan Elder, tax preparer, tax professional, also based down here in the DC, Maryland area. Been doing taxes for almost, I guess, say 8 years now, representing Guardian Financial Services, and been working with Zenith for the last couple of years as well. So thanks for joining and looking forward to this webinar.
Zenith Wealth Partners, if anyone's not familiar, is a financial planning firm. We do financial planning as well as investment management. We are a fee-only, minority-owned business. We do not accept any commissions. We do not sell any products. Our business model is custom advice tailored to our clients and their specific financial needs. All right, we are headquartered out of Philadelphia, and we just had our 5-year celebration last week in New York. Okay.
So Guardian Financial Services, been in business for about 40 years now. It was founded by Terrell Garrison. And I recently joined him, like I said, 8 years ago as a business partner of his. We're a minority-owned CPA firm. We do tax preparation, tax planning, tax advisory. We do offer other accounting services, as well as business consultation, as you see here. A lot of our clientele, not all of them, but most of them, have investments, rental properties, 401ks, and all that stuff, and also small businesses as well, most importantly. And so that's kind of the focus of who we work with. But, if you have a job or you just have some minor investments and all that stuff, we work with you as well. So that's pretty much it. So we'll get started. So the first thing I want to talk about is tax deductions and tax credits and the difference. So tax deductions are deductions that reduce your taxable income, right? So it doesn't give you kind of a dollar for dollar deduction in terms of your tax bill, right? It just decreases your taxable income, which does decrease your taxable income and all that stuff. But it's just a deduction. So for example, the standard deduction that the IRS gives you, which is about $14,600, I believe, for 2024, right? That reduces your taxable income, right? So, if your income is, let's say 80,000, then your taxable income after the standard deduction will be somewhere around 66,000 or 65,000. And also you can itemize your deductions as well in lieu of the standard deduction. And those that itemize the deductions, are typically homeowners that pay mortgage interest throughout the year, mortgage insurance premiums, make non-cash and cash donations, pay real estate taxes. And in some cases, if your medical expenses are high enough throughout the year, you can also deduct those as well, which can contribute to your itemized deductions, which raises your deduction that you can take, potentially, that's higher than that standard deduction amount that I said. Credits, all right, unlike deductions, are dollar for dollar credits off of your tax bill, which knocks down your tax bill directly and also potentially increases your tax refund. All right. And some of these credits consist of the earned income credit if you fall under a certain income threshold, education credits, child tax credit, child and dependent care credit, etc. So that's the biggest difference. Credits kind of do a little bit more for you in terms of your results ultimately, but both can be really good for you. So next slide.
Yeah, and Alan, we just had a quick question. Somebody
Oh,
asked,
good. Sorry.
is there a world where a taxpayer can claim both the standard deduction, but like pieces of the itemized deduction, or must they choose one or the other?
So it's one or the other, right? And that's the tax policy or the tax law, but it's also beneficial for you as well to choose one or the other, right? If you don't have itemized deductions, right, then you want the standard deduction because obviously that's 14,000 uh less on your taxable income. If you have itemized deductions that exceed that $14,000 threshold, you want to take that because that increases your deductions, which decreases your tax bill more. But you can't take itemized deductions and the standard deduction as well. It's either one or the other. Good
Right.
question.
Um,
And
and
I,
then-
oh, I
oh,
did
go-
want to mention, not to go too far down the rabbit hole, but this is also important for couples when they're married filing separately. Sometimes you will have to, whoever files a return, or when couples file married filing separately, they have to do the same deduction. So one person can't claim the itemized deduction and do all the mortgage and property taxes on one, and then the other person does the standard deduction. They would both have to do itemized, or they would both have to do standardized.
Correct. All right, Adrienne, I think this is your slide.
Yeah, but Chelsea, did you have something that you wanted to say?
no,
Okay, all right. So we wanted to talk about creating a tax strategy specifically for individuals. Alan is going to speak about couples and business owners as well as families. The first thing that we want to identify are the types of income or the sources of income. Questions that we ask clients are you a W-2 employee, or do you receive 1099 income, or do you receive both? Are you a business owner? Do you have investment income? Do you have RSUs or stock options? The reasons why we ask these questions is because it determines how you can file your tax return. If you're W-2, these wages will come in on line one. If you are 1099, you can either file them as other income, or you can do it on a Schedule a Schedule C for business income, and then you can deduct various expenses, which we will get to. This is also why it's important for us to know if clients are business owners, because we have opportunities to open up various retirement plans for them that may not be accessible to people who are W-2 employees. Investment income is important because you could have interest income if you have a high yield savings account, or you could have dividend income if you own corporate stocks, or even have money invested in a money market in a brokerage account. These are taxed in different ways typically. Interest income is taxed as ordinary income. This means that this is your ordinary income tax bracket, which a lot of our clients are in the 24, 32, 35, 37% tax bracket. On the other hand, you have qualified income like qualified dividends, long-term capital gains. Those are typically taxed at a more advantageous tax rate. If your income's over 500,000, I'm just taking a random number, then typically your long-term capital gain tax rate is going to be about 20%. Typically, our clients who may be in the 24 to 32% tax bracket will have long-term capital gain rates of 15%. This is extremely helpful and important because bonuses, stocks such as RSUs are taxed at your ordinary income tax rate, which could be a lot higher than the rates if you have qualified dividends or long-term capital gains. Alan spoke about the standard versus itemized deduction, so I won't talk about this too much more, but a lot of questions that we'll ask clients in order to identify what's more advantageous for them is, do you own property? Is it an investment property, or is this your primary residence? Do you have a mortgage? And that means you have mortgage interest that you're paying. In this high interest rate environment that we're in, we see a lot of clients who have higher mortgage interest rates. As a result, they're paying more in mortgage interest, which helps their itemized deductions. Property taxes also go into that, as well as any income you have paid to state and local taxes, for example, out of your pay stub. Charitable donations increase your itemized deduction. So if you're already over that, let's just say, for example, 14,600 threshold, any itemized charitable deductions a client will make on top of that will only help increase the deduction they will receive. But like we mentioned, it is not a dollar for dollar credit. It is a deduction to reduce your taxable income. And then finally, large out-of-pocket medical expenses. Typically, you are only able to deduct medical expenses that are over, I believe, 7.5% of your adjusted gross income. Your adjusted gross income is really your taxable income less your wages, all of your income less your deductions, then you get your adjusted gross income. Your medical expenses need to be more than 7.5% of that. A lot of people do not are not in that threshold. However, for example, we do have clients, for example, that may have large medical expenses like long-term care premiums. You can deduct that if it is over that amount, as well as any other medical expenses. So if you had a big hospital bill. Yeah. All right, next slide.
I just wanted to add really
yeah.
quick before we go to the next slide. It's really important to tax plan or have tax planning throughout the year and develop a tax strategy, because a lot of the income that you see here on the left outside of the W-2 is it's very helter-skelter, right? It's not stable. It could jump, it could decrease, so it just depends on where you're at business-wise or where your investments are at and how they're doing. But you want to, have a tax planning meeting with your tax professional, maybe quarterly or at some various points throughout the year, so that you can determine, okay, do I want to make some more charitable donations to, help my situation? Or should I buy a property to increase my deductions, whether it's an investment property or, own personal property, residential property for yourself? So, very important, to keep tax planning in mind throughout the year and develop a strategy so that, you're not putting yourself in harm's way tax-wise when you file. Sorry about that. Okay, so planning for couples with kids and creating a tax strategy, right? So the credits that you see on the left apply to most taxpayers with children. Obviously, the child tax credit, everyone is eligible for that for the most part. The child care credit is something that gets phased out the more you make. So the higher your income, the less you can claim in terms of child care credit. And the income threshold varies throughout the year, but definitely talk to a tax professional about where they are, throughout the year when you do your planning. The earned income credit, that only applies to folks that fall below a certain threshold. If you don't have any kids, I believe it's right around 15,000 or so. If you make more than that, obviously you don't qualify for it, and it goes up with each child that you have, right? Up to 3 or more children, I think it's like 40 to 50,000. So a lot of people don't qualify for the earned income credit, but you may, depending on your situation. If you're a business owner, you don't have the greatest of year in terms of profit and revenue, and you have children, that may apply to you. And then deductions. As it relates to children, I will focus on the 529 deductions. And so obviously the 529 plan is if you have a college savings investment plan for your child, which is called a 529 plan, you can deduct those contributions up to a certain dollar amount on your state tax return. So it's not a federal deduction, but it is a state deduction. And whatever it is, let's say it's $2,000 that you contribute throughout the year towards this plan. You can deduct that $2,000 from your state taxable income on the state tax return. All right. And depending on which state it is, depends on what form is used to include that deduction. But typically it's a form that, summarizes your subtractions to income for your state income, and that's where it will go. So definitely recommend, if you have a child, to have a college savings investment plan for obvious reasons. It helps in the long run to pay for college, but also it's a tax deduction as well on the state level. All right. Student loan interest, that applies to folks with or without kids, and IRA contributions as well can be deducted, especially if you're a business owner as well. So any questions about that?
Yeah, we had 2 questions. So one, we're in the world of social media, right? Where there's like a lot of noise going on. There's a lot of tax advice that's going on social media. And a common thing that people will see is like, the more kids you have, the better it is for your taxes. You get all these write-offs, you get all these things. People are running around trying to write off other people's kids and all these things. Like, number one, is that true? Like, does that actually have an impact, or have there been tax law changes where maybe in the past it had more of an impact than today?
So it's not as exaggerated as social media makes it, but yeah, the tax law, you can, like I said, the child tax credit, which is $2,000 in 2023, is going to be more in 2024, and future years, depending on the change of administration, all that stuff. But yes, the more kids you have, the more credit you will receive on your tax return. Now they give you the credit because obviously children are expensive, right? You got to take care of them, daycare, food, all that stuff throughout the year, clothes. But you do get a credit tax wise if you for each child that you have, right? And then obviously, like I said, if you have kids, you're paying for dependent and child care, which you get credits for those as well. 2023, that credit was $600 per child, up to $600 per child. And like I said, the more you make, the more you get phased out of that credit. But that is true. If you have children, or if you're claiming children and dependents on your return, um, you receive a credit for that. Obviously, there's also the dependent credit, which if you're taking care of a parent or a grandparent, and you're covering all their living expenses and all that stuff, you can claim them as well. And that credit is $500. But yes, the more kids you have, essentially, the more credit you can receive.
Okay. And then another one on this social media point, there's a lot of noise that's saying, if you put your kids, if you have a business, you put your kids on payroll, and then now you can contribute to an IRA for them, which I think is also where, like, potentially this deduction for the traditional IRA, or maybe they're doing an after-tax Roth IRA. Like, is that actually true? Like, can you do that? Or how does that even work?
Yeah, so the most effective way of using children in your business, I use the term using loosely, but putting them on payroll, right? Um, as a contractor per se, let's just keep it on that level. You can pay them throughout the year up to, what's the threshold now? I believe it was 12,000, but it's definitely higher now. But if you pay them, $12,000 throughout the year, right? And then you write them a 1099 for those payments that they received. One, you can deduct as a business expense that full $12,000 amount, right? But also your child is not obligated to file a tax return because they fall under the threshold for reportable taxable income, right? So that's an advantage of, looping your kids into your business, paying them and getting a tax deduction and avoiding taxes on that income, right? As far as the IRA and contributing to a 401k plan for your child, you would have to make them an actual employee. The structure of your business would then have to change. You have to be an S corp, and I will get to that. But essentially, it's a lot harder to do that. It can be done. And every employee that you do have at that point, you would have to offer that as well, that contribution towards their IRA, every year, so it can be, if you get to that point of it, it can be a little bit taxing for you. You have to talk to your tax professional, and even your financial advisor about whether or not that's worth doing. But that is an option. But the most popular one and the easiest way to, save on taxes and get some deductions is to put your kids on payroll as a contractor and having them avoid filing, taxes and paying taxes on that income. And you also receive the full deduction for that payroll expense. Hope that answered the question. Okay, so moving forward, I was getting into business owners. So if you have a business, right, you definitely, probably more importantly, is, I wouldn't say if you have a job, it's not important to plan. It's important to plan. But if you have a business, it's definitely more important to plan, in my opinion. Because like I said, there's variance in profit every year. There's variance in revenue, right? So you want to make sure that you're staying on top of that on a monthly and quarterly basis so that you're not hit with surprises throughout the year, right? So you want to know what your earnings are, right? You want to have proper bookkeeping, whether it's you're doing it yourself via an Excel sheet, or you have a bookkeeper, or you're doing bookkeeping on a certain bookkeeping software. You want to make sure you know what your earnings are throughout the year, and also what your expenses are throughout the year as well. Do you have investment income related to the business, right? That goes into what we were talking about. If don't have even if you have a business, but you still work a job, there's certain RSUs and stock options that you could be vested in. And you got to know if and when you're going to be paid out on certain equity with your job, and certain stocks and stuff as an investment, as an investor, sorry. And then you want to keep up with your expenses, right, throughout the year. Outside of the tangible expenses that you incur, like for payroll, paying certain fees monthly that you keep track of, that you're paying for every month. You want to keep track of some of your home expenses as well, because you qualify for a home office expense if you have a business. You want to keep track of your mileage that you're putting on your car, if you're using your car for business, and or keep track of all the car expenses that you incur throughout the year, for maintenance, and stuff like that. And then also, if your business owns property, or if you have a business that owns property like an LLC for a rental property, you want to make sure you're keeping up with the revenue and expenses of that said investment as well. This all goes into tax planning, and having a tax strategy and keeping up with everything on a monthly basis, so that you know where you are in your situation, and you know what to do throughout the year, or have an idea of what you want to do throughout the year in terms of deductions, so that you're not hit with a big tax bill when you file.
Well, Alan, I have a question for you. For your clients who are business owners, how do you have them track their expenses, for example, or their miles? Do you ask them to use QuickBooks? Is there another alternative?
Yeah, so QuickBooks is definitely what I suggest. It's really simple, because you can just link your bank account to your QuickBooks account, and all of your transactions, whether income or expenses coming in and out of your account, rolls over into QuickBooks, and then you can categorize them once they roll over, right? And it's a way for you to keep track of not only your revenue and expenses throughout the year, but the certain sub types of revenue and expenses throughout the year, and that's a way to keep track of it. And then, like, if you have business assets, right, obviously the bank account, but if you own property, own a car, other assets that the business own, you can also keep track of that and maintain a balance sheet. If you have a business loan, right, and you want to keep track of the amount that you've been lended and what you've already paid, that's another way to keep track of it. So definitely QuickBooks is the way to go. I believe the fee for QuickBooks, if you're not doing payroll, is somewhere in between $40 to $50 a month. Is definitely worth it. But if you don't want to pay that, and you just want to keep track of your expenses your own way, like I said, using an Excel sheet is definitely the way to go. But you definitely want to have something in place that's keeping track of your business activity, and knowing what's coming in and out, and where you are profit-wise throughout the year. Good question.
Okay. All right. So I'll take this 5 key considerations for your tax plan before a year end. We can go to the next slide. Right. Open enrollment time is coming up. So this is probably one of my favorite questions that I ask clients. When is your open enrollment? And a lot of times companies have it in the fall, because a lot of the elections start to take place in January of the next year. So this is open enrollment season. There are a lot of different ways to reduce your taxable income. We'll talk about retirement contributions, high deductible healthcare plans with the HSA, FSAs, as well as commuter costs. Now, retirement contributions typically can be adjusted outside of open enrollment. However, it is a good idea to look at it throughout the year. What we do for a lot of our clients is tax projections to say, hey, you're on track to actually not be in this tax bracket, and we want to bring you down some. You're not actually maxing out your 401k. Do we have an opportunity to increase your contribution so that we can reduce your taxable income and bring you into a lower tax bracket? As far as open enrollment goes, healthcare is a big one, choosing your health insurance. We recently put out a video about PPO plans versus high deductible healthcare plans. High level PPO plans are typically more expensive as far as your monthly premium and what you see coming out of your paycheck. However, you typically have lower deductibles. So when it is actually time to utilize your health insurance, typically pay less. High deductible healthcare plans, the opposite. Typically, you have lower premiums, but with that, you have higher deductibles. To mitigate the financial burden of high deductible healthcare plans, there is something called a health savings account. This is a medical savings / brokerage account, and you are able to put in your pre-tax money. There are a few different tax benefits. One is a pre-tax deduction, so that money you will not be taxed on. If you do use your HSA funds for medical expenses, you do not have to pay taxes on it ever. And then once you are in retirement, if you want to use your HSA funds for something else, you can use that without any penalties. Along with the HSA, you do have the opportunity to invest it in the stock market. Typically, you need to have some cash in there. Typically, we see that threshold at about $1,000, but anything over that, you can typically invest. So clients do have the opportunity to utilize their HSA throughout the year and use it for their current expenses, or they can say, I'm just putting this money away for the future so that I can use it for retirement and utilize this as part of my retirement plan. On the other hand, we have FSAs, which are the flexible savings accounts. They either use it or lose it. However, one thing I did learn about FSAs is if you switch jobs during the year, you can max them out at both employers. Or if you have 3 full-time jobs, you can, and they all have FSAs, you can do the FSA for all 3 employers. For 401ks, you can only put 23,000 in there, and that's how much you can do no matter where you work. But FSAs are different in that it depends on the plan as long as those companies are not related. So that's an additional tax benefit. You can use it on any health bills, hospital bills. And I had a conversation with a client and she was like, should I max out this FSA? I'm switching jobs. I already had one in my old job. I'm getting a new one. But she had a medical bill. So we were like, why don't you just use the FSA and put some on the medical bill? And that was an idea we had. Sometimes I talk to clients and they're like, I'm going to buy the Aura ring, and you can use that for the FSA. So make sure if you have the FSA, you do have medical expenses throughout the year that you can utilize for them. So for example, if you have a dental bill that you know is going to come up, or a procedure, or you're going to the orthodontist. And then we also have commuter costs. These could be pre-tax deductions. So if you are full-time remote, you may not need to have any commuter cost deductions because you likely will not use it. However, if you have to go in the office, you pay for parking, this is another way to reduce your taxable income. So what I would do personally is calculate how much it would cost for me to park on a monthly basis and then readjust my commuter costs. And you can only deduct up to, I believe, about $315 a month on commuter costs, and everything over that is no longer a pre-tax deduction. Generally, health insurance, vision insurance, as well as dental insurance, those are all pre-tax benefits, and those all reduce your taxable income. So if you're thinking, I want to get a PPO, but I really don't like that this has a higher cost for me out of my paycheck, just think about the fact that this could be a tax benefit as well. Right, next slide. Or we have questions. Okay.
We do have another question, which is, how does the IRS verify HSA spending is actually for medical expenses?
That is a good question. So what I have seen is that if the IRS comes to audit you, you have to produce expenses. So on different HSA sites, if you disperse that money, you can either have a card and put it directly towards that medical expense, or you need to keep receipts. So what would happen is if I took a disbursement from my HSA and I wanted to pay for therapy, I would put that on my HSA website and say, yep, I took out $200. I have it for therapy. I upload the receipt so that I know and I'm keeping track of this for the IRS. But Alan, I'm curious, since you are working with clients who have HSAs, this is not necessarily my wheelhouse now. So what would you typically?
So before we even get to the IRS, you know, when it's time to file, you have to complete a form 8889. And that's where you'll report your HSA distribution, and that's where you'll report how much of that went towards actual medical expenses, right? And then so that takes care of that, you know, when you file. And then if for some reason the IRS audits your tax return and asks you to verify that, you know, you use these HSA distributions for medical expenses, you know, that's where proper record keeping comes into play, right? So maintain receipts throughout the year, doctor visits, and all that, etc. Paying for prescriptions and all that stuff. That's where you would have to maintain that, whether it's your bank account or actual receipts or a folder that you have and all that stuff. But in terms of actually reporting it, you know, you just have to put it on form 8889. And that typically takes care of it.
So it's really the honesty policy is what we're saying when it comes to the 8889.
Correct. Yes.
Okay. All right, next slide. We wanted to talk about some of the various accounts that you could have as a W-2 employee. We started off with the traditional and Roth 401k. This is probably what most people are familiar with. You can also have a 403b, 401a, 457s could sometimes be included in this thrift savings plan if you work for the federal government. Typically, the tax status depends on which one you choose. So the traditional, it's pre-tax, the Roth is post-tax. The limit for 2024 is $23,000. You are able to put an additional $7,500 if you are over 50. New this year for 2025, there is an additional catch-up. If you are between the ages of 60 and 63, you can put 1.5 times the 7,500 that you could do if you're over 50. So that amount is 11,250. I believe it's still in Congress, but basically the musings are that it will get passed. And the annual limit for 2025 for the traditional Roth 401k will be 23,500. There are no income limits. You can put 23,000 in your traditional IRA if you have $1 million. A planning opportunity that we will sometimes tell clients is, say you get 25,000 in taxable interest income every year. It would behoove you to likely max out your pre-tax 401k to reduce your taxable income. However, this is not tax advice. This is information. This may not necessarily work for everyone, but there are additional planning opportunities for us to reduce the income with the 401ks. On the flip side, the Roth 401k, you do not get that pre-tax deduction now. You are paying taxes on that income. And so when you file your 1040, it will include that 401k amount. However, when you get into retirement, you are able to take that money out tax-free. Why is that advantageous? Because we do not know what the future tax rates will be. And you also may not know what tax bracket you will be when you're in retirement. Restrictions on the 401ks, typically, if you take it out before you're 59 and a half, you will get hit with a 10% penalty. Right. Then we have IRAs and Roth IRAs. These are pre or post-tax. A traditional IRA is typically pre-tax if you deduct it on your tax return. So we talked about those IRA deductions on your tax return. That is the traditional IRA. Roth IRAs, as well as backdoor Roth IRAs, is when we are putting money in a post-tax account and we're allowing this to grow. We already paid taxes on it. So for example, I have money in my bank account. It was already taxed out of my paycheck. I put it in a Roth IRA. I do not have to pay any more taxes on it when I withdraw it because this is a Roth IRA. The limit for 2024 is $7,000. An additional $1,000 if you are over 50, and the limit for 2025 is actually going to be the same, $7,000. Roth IRAs, it is important to note that if you make over a certain amount, you cannot contribute to this in the straightforward way where I just open a Roth IRA and I put money into it. If you make over 165,000 as an individual or 246,000 as a couple, you would have to do a backdoor Roth IRA, which is opening a traditional IRA, putting the money in there, moving it to a Roth IRA, and then on your taxes, there's a special form that you have to file to indicate that this is what you did. All right. Brokerage accounts. This is something that is not offered through an employer. IRAs and Roth IRAs are also not offered through employers. A brokerage account could function as a retirement account, but we call it a midterm savings vehicle because you are able to put money in there and invest it into corporate stocks, bonds, things of that nature. So when we think about bank accounts, you put cash in there and it sits and may accumulate interest. With a brokerage account, it allows you to then purchase stocks, which could appreciate over time. That is the goal. That's not always true, but that is typically the goal for brokerage accounts. There is no limit to how much money you can contribute. There is no limit to what income you can make in order to contribute. You could put 30 million in a brokerage account tomorrow if you have it, and there would be no stipulations. Right. Then we spoke about the HSA. This is pre-tax, but the limits for 2024 and 2025 for next year will be 4,300 for individuals and then 8,550 for families. If you are over age 55, then you can put an additional 1,000 in that HSA. Okay. All right, next slide, please.
Yeah, and just a quick question on this, Adrienne, because I know when working with clients, like you'll encourage people, make sure you're putting money in away for retirement, because this will help reduce your taxable income. But like, let's say if, Alan files my taxes and I see I have a tax liability of like $7,000. Does that mean if I just put $7,000 more into my 401k, then I won't owe anymore? Like, is that how we should be thinking about when we're increasing our 401k contributions? Will it automatically impact that final number?
Yeah. So 401ks are different from IRAs in that 401k contributions must be made before December 31st of the year. And IRAs, you can make those contributions until April. And how we mentioned, there are no dollar for dollar deductions. What will happen is if you put an additional 7,000 in your 401k before the end of the year and it's pre-tax, this will reduce your taxable income by 7,000, which will then reduce your taxes. I'm not sure what that exact percentage would be because we would have to do the calculations, but the answer is no, it would not be a dollar for dollar deduction. So what we normally do is run a side-by-side analysis for our clients to say, all right, this is what you're currently doing. If we max out your 401k, we'll do a side-by-side and let you know here, these are your different tax brackets. This is how your tax picture will change based on how much you will owe or get refunded at the end of the year. Did that answer your question?
Yeah, absolutely.
Okay.
All
right.
Okay. So charitable contributions. For those that, itemize their deductions, this is definitely something that you want to pay attention to. You can deduct contributions to qualified organizations like 501c3s, so churches, foundations, schools, various nonprofit organizations. You can deduct your cash contributions to them. You can also deduct any non-cash contributions made, so if you have some household items or clothes that you want to, donate and all that stuff, that can be deducted via your itemized deductions on Schedule A of your tax return. You can also deduct your, any volunteer expenses or any volunteer time as well. Here in Maryland, it's probably in other states as well. If you volunteer at, a fire department or some other government public entity, your hours can be, the hours that you work can be donated and deducted from your state tax return, which is, a pretty good opportunity if you're looking for some deductions on your tax return and decreasing your taxable income. Donor advised fund. These are, donations that you can make, to these 501c3s in terms of like investments and stuff like that, like stocks, where, you can donate stocks and they can grow for the charitable, for that entity tax free, and you can deduct that full amount that you donated to that entity. And the same with appreciated long-term capital property. that is also stocks, but that's also real estate, property, some other tangible assets as well that you donate, that can be deducted as well. I would definitely, before you make these deductions, talk to your tax professional, tax advisor on whether or not you should do it and how it's going to impact your tax return. But these are all contributions that can help you increase your deductions and, like I said, also decrease your taxable income. Any questions?
Well, I had a story about the long-term capital gains.
Yep.
So typically, if you have a brokerage account, if you sell out of it, then you will realize gains or losses. And what can happen is that if you have a capital gain, that could increase your taxable income and then the amount of taxes you have to pay. So a play is, I have this Microsoft stock, I have 100,000 in gains. Why don't I donate some Microsoft stock and then I won't have to actually realize the gain and I'm making my charitable contribution. On the flip side, someone mentioned a story about they had stock that was a loss. So let's just say, for example, Peloton stock. So if I wanted to donate some Peloton stock, that would not make sense, because why would I not to take the loss myself? Why would I give that stock that is at a loss to the company when I could just go ahead and take it for myself? That's just what I share.
Great. Yeah, that's good. And that's why I said, like, definitely talk to your tax professional, right? Because they would, look at your investment statements and how well they're doing or how bad they're doing, and they can advise you on what you should do with those investments, whether donate them or keep them for yourself to help your tax situation. So, yeah.
All right, tax loss harvesting. So I guess I just talked about that since I was talking about the long-term capital gain and depreciation and losses. Okay, so reducing capital gains and tax owed, this is really the goal of it. So if I have stock and I sell it, then I have a capital gain, like I just mentioned. However, tax loss harvesting is an opportunity, and I want to take it back to August 5th when the market actually came down a bit. And a lot of people were concerned because they didn't know when it would be corrected. If I knew when the market would correct, like, I would be filthy rich and I wouldn't work. I would be on an island somewhere. So that's a whole other story. But for capital gains and tax loss harvesting, looking for opportunities when the market does retract and see if there are any losers that you could sell and receive any tax benefits. The main thing to note about capital losses is that you can typically only deduct $3,000 in the year. However, if you do have capital gains, you can offset your capital gains with the capital losses. So if I have 10,000 in capital gains and I have 12,000 in capital losses, I can deduct 10,000 in capital losses, and then the remaining 2,000 would also be deductible. If, for example, I had 15,000 in capital losses and 10,000 in capital gains, I would only be able to offset that 10,000. I would have 5,000 in capital losses left. Only 3,000 would be able to be deducted in this year, and 2,000 would get carried forward, right? The wash sale is so important when we're talking about capital gains and losses, because if you sell something and within 30 days on the front or back end, you decide to buy that stock again, they will cancel out the gain or the loss. So for example, I may have sold off some Microsoft stock when it fell and I took that taxable loss. However, if 28 days later it went back up and I wanted to get back in Microsoft, that would cancel out the losses that I took. All right, so that's a way for us to take advantage of the volatile markets, like I just talked about. And I did mention how you could carry those losses forward. Okay. Roth conversions. This is something that does have taxable implications typically for clients, because we are moving pre-tax dollars that have not been taxed into a Roth account, which will not be taxed anymore. So what happens is that it does typically increase your taxable income, and you have to pay the taxes on it. Now, the advantage of the Roth, which we talked about, is tax-free growth and distributions, as well as no required minimum distributions. So when you have pre-tax 401ks and IRAs, once you get to your 70s, they require you to start taking money out of it. However, if you have Roth dollars, you do not have to take money out of it. This could be beneficial if you want to gift it as an inheritance to someone, right? The pre-tax, you'll have to pull those out and then reallocate it somewhere else. There are no income restrictions on if you want to do a Roth conversion. The main thing that we want to think about is how it will impact your tax picture. So if you have a pre-tax 401k that's worth $100,000 and you decide that you want to do a Roth conversion on that, you better be prepared to pay whatever your tax rate is. And you may say, well, my salary is, 100, so I'm in the 22% tax bracket. Well, no, because now you have 100,000 Roth conversion added on top of that. So your taxable income is actually now 200,000. So be prepared to be in the 24% bracket, pay the taxes on that. So let's just say 24% on 200,000. And then we'll also talk about, for states, you'll typically have to pay state taxes as well. So Roth conversions, making sure you have enough income or cash on hand in order to pay for those tax implications.
Absolutely. And I would like to add, Adrienne spoke about backdoor Roths earlier. It's important to communicate to your tax professional that you did do a backdoor Roth IRA. And the reason why is because the tax form that you receive, which is called a 1099-R, I think this is kind of a glitch. I wouldn't say a glitch, but just a imperfection in the IRS's reporting documentation. It looks like a early distribution, right, from your 401k that you just took out from your traditional, and it doesn't look like a Roth conversion, right? So your tax professional will have to take that document and fill out Form 8606 so they can report it as a conversion and not report it as a distribution. Which obviously helps you tax wise, so you don't have to pay additional penalties and all that stuff. It could just be a conversion, and you'd be taxed on converting the traditional retirement account to a Roth, right? So definitely, like I said, just stay in communication throughout the year, and then even during tax filing season, when you meet with your tax professional before they prepare your return, make sure you let them know that that's what you actually did. It's a backdoor Roth conversion, and so that they can properly fill out the form 8606 and report it to the IRS correctly. Okay, so business structure for all of my folks with LLCs and businesses. Most clients do these days, whether it's something small, whether it's a rental property, etc. In order to save on taxes or to help yourself tax-wise, you need to form your business correctly, right? And your business formation dictates how you are taxed by the IRS, right? So if you have a business and it's not an LLC, and you're just a sole proprietorship, that's what you are, right? And you'll be taxed as a sole proprietorship. You'll be taxed as a self-employed business owner. Same with an LLC. They're taxed the same exact way, right? And when you file and you report profit from that business on your tax return via the Schedule C, if you look at line 23 of the 1040, you'll see that you're paying self-employment taxes on top of the income taxes that you're already paying for that income, right? And after a certain point, when you get to a certain point in terms of profit from your business, it is wise, and it could be wise and advantageous for you to elect to be taxed as a S corporation, right? And what that does is it allows you to become an employee of your business, receive a salary from your business, and avoid paying those self-employment taxes. Self-employment taxes is right around 15% of your business profit, right? So that can be a hefty bill, especially, for the businesses that report, 100 grand in profit every year, right? So very advantageous, like I said, to convert to an S corporation and elect to be taxed as an S corporation is probably the proper term. In exchange for becoming an S corporation, right? Like I said, you have to write yourself a salary. And when a business has employees and they're writing salaries, they have to pay something called a payroll tax, right? Which is also about 15% of that salary amount that they're paying in total, right? So let's say in the example that I used, $100,000, right? If you report a profit of $100,000 on top of the income taxes you're paying, you're also paying an additional $15,000 in self-employment taxes. If you elect to become an S corporation and you write yourself a salary, let's say in the amount of, I don't know, let's do 40,000, right? Your payroll tax bill is going to be right around, I would say 8,000. My math is maybe a little off. All right. So, and you're paying that throughout the year, right? Quarterly, right? You're not paying 8,000 per quarter, but depending on what your salary is in that quarter, it could vary. But throughout the year in total, your total payroll tax bill is right around 8,000, right? So the difference between 8,000 and 15,000 is significant. That's $7,000 that you're saving yourself by structuring your business a certain way, right? So I know that's probably foreign to a lot of people, and it's a very complex way of explaining things. If you would like to have a more detailed conversation about it, certainly talk to your tax professional about whether or not you should elect to be taxed as an S corporation. But typically, once you cross the $75,000 threshold in profit, it is advantageous to do that, especially if you believe your business is going to continue to grow year after year after year. You definitely want to convert. And then C corporations, that is a different business structure than the S corporation. S corporations are, the difference between S corporation and C corp is a S corp is a smaller corporation with 100 or less shareholders. C corporations, have more than 100 shareholders. Those are for businesses that have a lot of investors and shareholders. Also, there's other advantages of being a C corporation. As an S corporation and an LLC, you're a pass-through entity. So if your business has profit, whoever the shareholders or the owners of the business will pay taxes on that profit, right? But if you're a C corporation, the shareholders of the business do not have to pay taxes on that business profit. The business will be responsible for that. And then the shareholders will have to pay taxes on whatever distributions they receive throughout the year and or salary that they receive from the company. So I think we had a question come through. I'll stop and I'll let that question get asked so we can answer it.
Yeah, I was just queuing the audience to see if they had any questions as we're getting close to the end here.
Oh, okay. I thought I saw a question come through. Sorry. So yeah, again, just to summarize this, structuring your business matters, and it can be the difference between you paying, $10,000 in additional taxes or $5,000 or $20,000 in additional taxes from $10,000. It can really save you a lot of taxes. And this goes back to, my suggestion about tax planning and tax strategy, bookkeeping, knowing where your business profit is throughout the year and what your projections are so that you can make these determinations and decisions, not just based off of electing to be taxed as an S corporation, but also determining what salary you should write yourself, and all of that stuff. Retirement accounts play a role into this as well. The deductions you can take from your IRA is dependent upon, and how the deductions are actually reported is dependent upon your business structure, right? If you're an LLC and you have an IRA, then you can deduct that IRA contribution on your personal tax return, and that can decrease your taxable income. If you're an S corporation, employee retirement contributions, are counted towards business expenses, which, directly decreases your profit that you report throughout the year, and obviously decreases your taxable income that way. So, again, I'll stop and see if we have any questions about what I discussed on this slide or anything else. If not, we can move forward. It's fine.
Yeah, and I know we're getting towards the end, so
Yeah.
what we'll do is we'll share this deck out with everyone too. And if you have any follow-up questions, of course, we're here and would love to set up some time to connect and see how we can be a resource for you on your financial journey. And then Alan, I know individuals can do the same with you as well.
Sure. Sorry I took up a lot of time, Adrienne, at the end. I apologize.
So I guess I would ask, like, since we're in Q4, if there's one nugget everyone should walk away with on like as they're thinking about their benefits, their tax picture that they should revisit, what would that be?
For me, I'll go first. I guess I keep harping on this, but business owners definitely um take bookkeeping seriously, right? So that you can know your projections. Once you know your projections for the year, then whenever you do meet with a tax professional, or if you try to do things on your own, um, you have a clear picture of what you should and need to do, right? Um, and that's my biggest nugget. I think also, if you are someone that itemizes your deductions, you have mortgage interest that you pay throughout the year, definitely look into making some non-cash donations, and cash donations as well, to increase your deductions, because that can certainly help. And then the last nugget I have is, um, work with a tax professional, right? Meet with a tax professional between now and November and December, maybe between now and November, so that you can know what to do as you close the year out with increasing your deductions or contributing to retirement, et cetera, et cetera. That's one thing that I think people should take away from this.
My comment was going to be based on the timing. Now is the time to be connecting with your tax professionals. We can always give advice, but a lot of times it takes time to implement things. If we tell our clients, open up a donor advised fund so you could put a lump sum of money, if someone comes to us in December 15th, it's going to be really a rush if it could even happen. Sometimes people come to us in February and they're like, what can we do for last year? And we're like, well, December 31st was the cutoff. Look for planning opportunities in order to pay things this year that you may have due next year. So for example, what we'll sometimes tell business owner clients is, you have to pay this bill in January. Why don't you just go ahead and pay it in December if you are cash basis as a business owner, so you could take that deduction in the current year. Same thing for charitable contributions for any W-2 employees, things like that.
Yeah, and one last thing to piggyback off that, Adrienne. For those that know they owe every year, definitely make your quarterly payments throughout the year. If you haven't been making your quarterly payments, you can still make up for that by making some payments to the IRS to avoid penalties added to your balance when you file. That's a big thing. That can save you a couple grand as well, depending on your balances. But definitely make, your estimated payments for 2024 before the year ends.
Got it. So basically, I'm hearing be proactive, make sure you check in with your team, your tax professionals, have that year-end review, and make sure you maximize as many deductions as you can before December 31st.
Absolutely.
And then align with open enrollment. Don't just set it and forget it every year. Sometimes people are like, yeah, I just keep doing the same thing. Your situation may change from year to year. If you are pregnant, which I mentioned in your video, you may not want to be on that high deductible healthcare plan anymore. You may want to be on a PPO so that you don't have to hit a big deductible. And let's say you're pregnant and you're due February of next year. You would probably hit your deductible in 2024, and in 2025, it resets. So this is something that I wanted to emphasize as well regarding to open enrollment.
Awesome. Well, thanks, guys. There's been a lot of information. We shared a lot of knowledge. I hope this has been helpful for everyone. Where can people find you if they do want to connect to get some more tax advice?
Definitely can find me here. Email me. That's the best way to get in contact with me. This is our Instagram page. My Instagram page has my booking link if you want to schedule a tax consultation call with me. Those calls are free. And yeah, that's how you can contact me.
And for me, either through info@networthzenith.com or my email, Adrienne, ADRIENNE @networthzenith.com, or it says is the best way to get in contact. Or you can also go to Zenith's website, zenithwealth.partners, and you can go to work with us and schedule an introductory call.
Awesome. Well, thank you both so much for sharing a lot of knowledge and a lot of great advice. And I hope everyone has a wonderful evening.